Hi, everyone, and welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I am your host, Denny Troncoso. This is episode number 12. If you were with us on our last podcast, episode 11, Desi and I had a great conversation with Joe LaFleur with 100units.com. It is a great episode for people looking for tips on how to increase their deal flow from commercial real estate brokers. Make sure to check it out. In this episode, Desi and I interview Rusty Rich, a commercial real estate appraiser. It is an episode packed with tips on commercial property valuation. This is a great episode for those wanting to know how appraisers come up with their values, and as investors, how you can come up with your offer. As always, be ready to take notes. If you don't already, please follow us on Instagram at Denny Troncoso or at Desi Troncoso. Hey everyone, and welcome to Everything About Wealth, the podcast. I'm Denny Troncoso, and I'm here with my business partner and life partner, Desiree Troncoso.
Hey everyone.
Hey, and we're getting ready to have a great call with Rusty Rich. Rusty Rich is a commercial property appraiser, and he's a graduate of the University of North Carolina at Chapel Hill. He received his Bachelor's of Science there. And he also is a graduate of Johns Hopkins University, where he received his Master's of Science in Real Estate in Appraisal and Valuation. He's currently a Senior Managing Director with Integral Realty Resources in Birmingham. And Mr. Rich has over 20 years of commercial real estate valuation and advisory experience. So he knows his stuff. He focuses on the Southeastern and Mid-Atlantic United States. Since 1998, Rusty's performed appraisal assignments on a wide variety of commercial real estate product types, including office, retail, industrial, multifamily, hotel, mixed-use properties, as well as vacant land. Rusty's also worked with a variety of clients, including pension funds, REITs, insurance companies, attorneys, owners, developers, and so much more. Rusty, are you there?
Yes, I am.
Thanks for being on the call today, Rusty.
No, I appreciate the invitation. This should be a lot of fun.
Yes. I look forward to talking real estate with you.
Yeah, it sounds like you have a heck of a resume there.
I was just thinking when Denny was reading it, I was like, that sounds great.
Is that me?
Yeah, seriously.
Yeah. But I mean, it looks like you put in a lot of work and time to build yourself up and develop your skills. And I respect that. And I look forward to learning as much as we can from you.
Yeah. And I guess, Rusty, we've heard a lot about you from Denny's introduction, which just sounds like you are very knowledgeable in the field. What made you decide to get into the appraisal field?
Well, like many folks, 20 some odd years ago, I'm getting out of college. I'm looking for a job. Real estate's always been something that intrigued me. My family's owned a few, shopping centers or properties here and there, nothing, overly extensive. I grew up in North Carolina, so in a small town. So we owned a few properties. I always found it interesting. And, during my interview process, I just got an opportunity with a really good, smaller real estate firm in Washington, D.C. that valued a lot of institutional quality properties like, office buildings in downtown D.C., things like that. So it was a very good opportunity and really it gave me a great amount of experience in a short amount of time. So I thought it was a good chance to, move away from home, but not that far away from home, move into a kind of a top 5 market in the country. And it was fantastic. So that's how I kind of got into it. It's a little bit in the blood, but at the same time, it was just a really good opportunity at the right time.
Very good. And I see that you have a Master's of Science degree in real estate appraisal and valuation. Now, to become an appraiser, is that the direction or path that most appraisers have to take, or is that something that was just specialized with the degree that you were seeking?
Yeah, I would say most appraisers go through, there are several education providers. Most people take their classes through the Appraisal Institute. So there are several classes that you need to take to get your certified general or certified residential appraisal license. What I did through Johns Hopkins, they have a real estate program to where if you go through their master's program, it meets a lot of the classroom requirements for a certified general or an MAI designation through the Appraisal Institute. So, when I was looking at it, I was like, okay, I can either go through the Appraisal Institute or I can go to Johns Hopkins and basically meet all the classroom requirements and kind of end up with two pieces of paper instead of one. So I went, the Johns Hopkins route. And then in addition to that, to get an MAI designation, for example, there are some additional classes, but then you have to get experience credit and peer review and write a demonstration report, pass a comprehensive exam, things like that. The Johns Hopkins route is one route, and there are several schools now that have that sort of affiliation with the Appraisal Institute. But that's what I did. A lot of people take their classes through the Appraisal Institute, but to really answer your question, I mean, there are several different ways to do it. But there is a lot of additional education that's required as you get into the field to become licensed.
Your path, you had it in your blood with a real estate background with your family, but then you went on your own route to become a professional. Because one thing is being an investor and owning property, then one thing is becoming also a professional in the industry, which is also what you did. What stood out about that, the career? Anything that you weren't expecting? I mean, and we're talking about the coursework, the material, where there is the finances, the spreadsheets. What stood out to you, and what did you enjoy the most?
I guess I'm sort of a project-based person. I like the idea of getting into something, kind of getting your hands dirty with it, learning everything you can about it, but it has kind of a finite duration. And that's one reason I like, commercial properties rather than residential is if you're doing a residential appraisal, you're kind of in and out. With a commercial property, you really get to learn the nuances about the property and what kind of makes it tick, and really learn a little bit more about the market. I like the idea of being able to kind of dive in head first, really submerge yourself in this particular property and market for a week or a couple of weeks. And then, once you kind of, develop your opinion of value, get your answer, learn about it, there's a sense of accomplishment when you're done. Then you're ready to move on to something a little different. And that's kind of what makes it interesting is, you might be doing an industrial building one week and the next week you're doing an apartment. The next week you're doing a shopping center. So the diversity of it is pretty attractive. It just kind of keeps things interesting.
And in your current market, are you currently still doing all the different varieties of commercial real estate, office, retail, multifamily, or are you specifically in certain niches there?
I tend to be a generalist. I mean, appraisers come in all sizes, shapes. I'm in Alabama. Our market's not overly diverse in the sense of its depth, let's say. So, it's hard to be somebody who specializes in just doing hotels in Birmingham or in the state of Alabama. It's just, there's not that much product necessarily. I tend to be a generalist, and I run an office for a national firm. So we kind of, we stick to a lot. We do a lot of different things, but there are certain property types that we have specialty practices, for example, in our organization for things like seniors housing and healthcare, whether it's hospitals or assisted living or things like that, or hotels, convenience stores. There's certain property types that have their own special little nuances, and it's my personal feeling that you kind of either do those or you don't do those. I don't think you should do certain property types if you're going to do one of them every couple of years, because if you're not doing it consistently, you kind of miss current trends and what's going on with the market and how people are treating different things. To answer your question, I do a lot of different things. It is mostly kind of your office, industrial, retail. We might appraise a lot of churches, a lot of apartments. When we have kind of specialty properties that I would refer to, I'll tend to bring one of our outside experts in and kind of work with them on the appraisal. So, they might do the heavy lifting on it, but maybe I'll help with local market knowledge and some research and things like that. So that's what we do. specifically, but like I say, appraisers do come in kind of all shapes and sizes. Some people, specialize in one product type or two product types. I tend to be more of a generalist, but when it does get to really specialized stuff, I'm lucky to have a network where I can kind of hand it off and we can work together. So we can still service our clients, but I'm making sure that I'm working on the things that I'm best suited to work on.
Mm-hmm. The great thing is you can still serve people that need really anything, whether it is you fulfilling that need yourself, or you have other partners within your company that you can hand it to, that they could still serve that client, and that client doesn't have to go anywhere else. Is that right?
Yes, that's exactly right. And that's what we try to do. And if it's a situation where it's something that's really, really unique and I have a, contemporary who I can say, look, here's who you need to call for this. I mean, I'll absolutely refer it outside our organization when it's necessary, because ultimately, if you're taking care of your clients, they know when you're taking care of them and when you're not. And so I think they appreciate it when I say, I could do this, but I don't think I could do it in a very cost-effective manner, or I just know somebody who is better suited to this specific property. Mm-hmm. And let me give you their name and number. You lose an assignment, but you might gain a client for life because they understand that you're really looking out for their best interests. So mm-hmm. That's what I try to do.
Makes sense.
Yeah, I definitely would agree with that. So Rusty, we're going to get a little bit more into the
meat and potatoes
of doing an appraisal. So can you briefly explain the different approaches to valuing real estate, which is, the income approach, comparable, or the replacement method?
And we're trying to target someone that maybe is interested in getting into commercial real estate. They understand investing, but they're not too familiar with the approaches, or someone that maybe wants to invest their capital in a project, but they want to be a little bit more familiar with some of the terminology. And
Sure. Well, to start with, I'm a commercial appraiser. All the approaches are very important, but if you're looking at investment type real estate, the first approach you're looking at is the income approach, which is basically, if I'm buying this, what's in it for me? I'm buying it to make money off of it. So what the income approach does essentially is, you look at the property, what can I get in terms of rents? What are my expenses going to be? And then what's a reasonable rate of return for this asset, compared to other investment vehicles where it's a CD where you might get 2%, not anymore, but,
yeah, I don't even remember last time, right?
Yeah. Or I'm investing in the stock market. What are my dividends? It's like, right. Okay, do people pay dividends anymore? But you're looking at, what are alternate investments and what's a reasonable rate of return for this type of real estate? And different types of real estate have different rates of return, and different locations have different rates of return. But basically, the income approach, simplistically, I'm looking at a property. What do I think I can get in terms of net income after my expenses are paid? And then what's a reasonable rate of return for that property? Is it 6%? Is it 8%? And what you do is basically capitalize that income. Simplistically, if you got $100,000 of income and I'm capping it at a 10 because I can do the math in my head, it's worth $1 million. Mm-hmm. So simplistically, that's the income approach. The sales approach is basically looking at other properties as similar to your property as possible that have sold, and what are they trading at? And usually the approaches kind of go hand in hand. You shouldn't get a vastly different value on your income approach as you do in your sales approach. And the reason there is the sales approach is all about the principle of substitution. What can I buy a substitute property for? If I can buy the property across the street and it's the same property and it's listed for sale at $50, why am I going to buy this one over here for $60? So that's why it's important to look at sales. And the sales approach is, most familiar with people in terms of doing their home mortgage.
Right.
When you buy a house, you're looking at other properties. Hey, and people don't necessarily realize it, but they're doing the sales approach in their head all the time when they're buying a house, and they're making adjustments in their head. Well, this one has a pool, that one doesn't have a pool. Well, that bedroom's a little bit smaller. I don't really like that. I really like the bathroom in this master bathroom. So they're going through the sales approach process in their head, whether they realize it or not.
Good point.
So yeah, that's the sales approach in a nutshell. And then the cost approach is what's a reasonable replacement cost for this property, less any depreciation. If it's 10 years old, there's a certain amount of depreciation. If it's brand new, there's not any. And once again, that gets back to the principle of substitution as well. If this property is listed for $100, but I could build a brand new property for $90, why would I buy this one when I can build one for less? Now, granted, there's a headache in terms of building a property and having to go through it. You might pay a little bit above replacement cost just to not have to go through the headache. But that's how it generally works. Is generally speaking, you're not going to pay more for a property than it would cost you to build a suitable replacement. That's the third approach, and that's kind of how they all tie together.
And when we're talking about the headache, we're talking about the time it takes to build it, maybe 24 months, over budget, risks, things like that.
Absolutely. Yes. And just the headache and the coordination of everything. I mean, if you've ever done a very minor renovation to your house, you understand what it's like to get the plans and get with the bank and get with your contractor, and he's got a subcontractor, or you the contractor and you got 3 subcontractors. I mean, it turns out to be a major headache. Some people would just rather buy it themselves rather than build it themselves.
Yeah, that makes a lot of sense. Now, through all those different approaches, do you think, looking at it as an investor perspective, is there one that holds more value in the commercial industry?
Difficult question. I guess I could answer it a few ways. I mean, the different property types are certainly different. For example, if you're buying a retail property that's leased to Dollar General for 15 years, you can say you're buying real estate. What you're really buying is a bond that Dollar General's backing, and that they're going to pay you X amount of money for the next 15 years, and you don't have to do anything except go to your mailbox and
get a check.
Take it to the bank.
That's the laziest or easiest way to own real estate, right? One of the easy.
Yeah, you let them do their maintenance and all that stuff, and but when you're asking about holding value, I mean, that holds value in the sense that you can sell it to somebody and you might hold it for a few years and you can still sell it. And there's 10 years of this solid income stream. Where it becomes a problem is, what happens with that asset when the lease is getting close to running out or when it does run out. So I wouldn't say that necessarily holds value. It might be a great investment for 15 years. But in terms of holding value over the long term, I mean, I think what you see, properties in really good, solid locations are always going to hold their value. Like I said, I've spent time in Washington, D.C. That's where I started my career. If you can be within a few blocks of the White House, there's a good chance that location's not going anywhere.
Yes, a little.
And if that location does go somewhere, let's be honest, that's the least of your concerns. Meaning your investment's the least of your concerns. Location is a real driver in terms of holding value. But in terms of property types, I think what we see is if you look over the long term, capitalization rates, which are, rates of return, might, bump along at 8-9% for industrial space, retail space, office space. You usually see multifamily apartments at slightly lower rates because regardless of what's happening in the economy, people still have to have a place to live. When the economy does get bad, a lot of times it impacts people's ability to buy a home or stay in a home. But like I said, they still have to have a place to live. If you go into a significant economic recession, companies who are leasing office space or leasing retail space, they tend to either close up shop or downsize, whatever. You still have people needing a place to live.
Right.
And if you own a shopping center and tenants aren't leasing space, you can't discount your rent enough to convince people to rent space. Whereas if you have an apartment property, you can fill it up. You might not get the rents you want, but you should be able to fill it up. I think for that reason, multifamily tends to hold value a little bit better, and you see slightly lower rates of return because there is less risk perceived with that. if I had to answer your question simplistically, I'd probably say multifamily tends to hold its value a little bit better for those reasons. As an appraiser, the answer to any question is pretty much, well, it depends. So I'm trying
Rusty,
not to
you
answer
sound
your
like an
question with
attorney
it
when you
depends.
say that.
I don't, and I'm not. Let me say that.
So, so we talked about if you were appraising a multifamily property. Let's say I was going to hire you, which we have hired you in the past to do work for us on a multifamily property. But what type of work is it that you're doing in the office? What type of work are you doing out in the field? I know there's a market analysis that is part of this. Walk through that process.
Yes, what we'll do, and it's really no specific order. What we do out of the office is, I want to go look at your property. I want to make a good tour of it, get a good feel of it, look at enough units to where I have a good representative sample of the unit types. If there are any renovations, are there any renovated units, not renovated units? I kind of want to understand those differences. I want to drive around the neighborhood of the property. Look at the general upkeep. Is it a nicer neighborhood where people are taking care of stuff? Is it kind of run down? I'm looking at your property. Does the parking lot, is it in good shape? Are there potholes? Is the roof in good shape? I'm forming opinions about that. Ideally, looking at other properties that you compete with, some of that's done in the office because the internet's a wonderful tool for that nowadays. But there's a certain amount of driving the neighborhood and looking at it. And I want to identify your competitors. So whether I do that out of the office by driving around or on the internet, it's usually a little bit of both. But I want to drive by those, see how those properties compare with yours, because I want to examine what your rent levels are, looking at your rent roll and your asking rents. But then I want to call those guys and try to get them to talk to me. What are your asking rents? Can you tell me how occupied you are? Are you running any specials? What are you guys seeing in the marketplace? Who are your main competitors? So we're doing all that kind of primary research and done a mix out in the field and then some in the office. And then when we get to the office, we're really trying to analyze that data. How does our property compare with these other properties in terms of rent levels? Looking at expenses at our property, expenses at other properties, and then trying to kind of formulate our opinion of value in terms of where do we stack up, what's reasonable for our property, and then how do we relate to everyone else. In short, we ride around, we look at different things in the market, and then we do research. Subscribing to different resources. We want to look at the inventory, the vacancy, what's coming online, what's a good snapshot of where our property is today, but where do we think it's going to be in the future and why? That's what we try to do both in and out of the office.
Now, if you were going to, part of your market analysis, you mentioned that you're looking at other comparable properties. Is there a hard, fast rule, or I know this is probably one of those, it depends. So when you're looking at the other comparables, how far are you looking? What are you looking in those comparables to your property?
In regards to distance?
Yeah, in regards to distance and even any other factors that you evaluate to compare.
No, that's an excellent question. And the answer is definitely it depends.
I love this. This is easy. No,
it does. Because like I say, it's if I'm looking at an apartment property, obviously it's talking to those property managers and who's your main competitor. You could be in an extremely small market and you might compete with somebody in a neighboring town. Generally speaking, that's not going to be the case. For an apartment, your competition in terms of the income approach and your rent comp should be right there in your local market area. That being said, if we were looking at a smaller market in Alabama, maybe a town that has, 30,000 people or something, might have 6 or 7 apartment complexes, whatever. Well, the chances of having, when we're doing the sales approach, we don't want to go back more than a year or two, or, that depends as well. But you don't want to go back any further than you need to in terms of sales. But if there's only been one sale in your market, or there haven't been any sales of comparable properties in your market, you go look at similar sized towns. That could be the next town over. It could be 200 miles away, but it's a similar town. It's a similar distance from Birmingham or Huntsville or, Orlando, wherever.
Mm-hmm.
So it really depends, and it depends on what approach we're looking at. And there are certain property types where if you were appraising a new Amazon warehouse that's 1 million square feet, your market's probably and it's leased to Amazon for 20 years, your market's probably the entire country. Minimally, it would be on a regional basis.
Mm-hmm. That makes a lot of sense.
Because how many, 1 million square foot leases are out there and 20-year sales of, Amazon type credit properties. So like I say, it really does depend, but I think with that answer, you can kind of see where it would vary from property to property. Generally speaking, the smaller the property or the more homogeneous the property, the more kind of run of the mill it is, the easier it is to find comps in your local area. The more specialized or larger it gets, generally speaking, the wider you have to go geographically. A hotel would be an example. The only thing that would go against that is, for example, the Dollar General that I brought up previously. There are Dollar Generals all over the place in the South. I can look at, say, hey, there was a Dollar General that sold 3 years ago, and it's right down the street. That's great. But you have to remember, people are buying a cash flow stream from Dollar General. They're not necessarily buying a real estate asset in that case. In cases like that, we might go regionally, and we want to get the most recent sales of Dollar Generals as possible, because the location doesn't necessarily tell us as much, because investors are really buying a cash flow stream from Dollar General, and that's what they're paying for as opposed to the real estate. So investment rates of return might have moved significantly in the last 3 years. So you could have a sale of a Dollar General in the next town over from 3 years ago. It's not as good of a comp as one that might have sold in Tennessee last week. So, because it tells you what investors are currently doing at that time. So, like I say, that's why the answer is it depends. But those are a couple of examples of, what it would depend on and why you might do different things in different situations. So hopefully that kind of answers your question.
No, it did. It did answer the question. And I think it's a great point, and I'm glad you brought it up, because a lot of times, especially if you're working with a real estate broker, you want to make sure that the comparables, especially when I think it comes to the income, that it's in the area. I understand sales, sometimes you may need to go further out, but I like the point that you made in regards to if you're trying to buy an income producing property, and we do more multifamily, so I'm going to reference multifamily, try to find what's in the area, because sometimes we've seen brokers include income from completely different cities, and there's no way you would get that income in a smaller market.
Yeah, well, you have to make an adjustment for that.
Right.
And that's where when you hire someone like Rusty, he would look at that city, but then he would compare if you can actually get those rents in this particular city. But I was thinking the same thing. You get a package, and I kind of, it makes me understand it better now, because we get packages from brokers all the time, and even an appraiser, and you say, why are they using this comp in Timbuktu? And the reality is that's the closest market that's as similar to the market that they're appraising. So it's enlightening to hear that. I feel for
them.
And that is
yeah, and that is definitely something to look at, and that's just something that you as an investor or as an appraiser need to look at. And if I get a broker package and an offering memorandum and it says here's what it is, you have to do enough homework to say, well, why are they using that comp? And you don't just need to throw it out simply because it's not in your local market. You need to know that is it because that's really the best comp and there's not anything here locally, or you do enough research to understand that, that's really not a great comp. But that's where it's on us as the appraisers, or on you as an investor, to do, your own homework and form your own opinions as to what it is. And what you just said it reminds me of something that I learned years and years ago, or I was told years and years ago in Washington, D.C. I was probably 2 or 3 years in the business. And I was calling a broker and asking him, I said, what do you think the cap rate is on this? And his response was, it depends. But, I said, depends on what? He goes, am I buying it or am I selling it?
Yeah.
I said, well, that's interesting, because he's like, look, I'm a broker. He said, if I'm buying it, I'm going to try to, beat it up and have that cap rate as high as possible. If I'm selling it, I want the highest price possible. So I want the lowest cap rate possible. So if I'm selling it, I'm telling you it's 7 cap rate all day long. If I'm buying it, I'm saying it's not any more than 8. Like that's it.
Mm-hmm.
So you just have to look at the source, look at where you're coming from, where you're coming from. And don't get me wrong, there's plenty of great brokers out there, and there's plenty of offering memorandums that are very fairly priced, whatever. But you have to remember their job's to sell something.
Right.
And a lot of times their job's to sell something, and the owner wants to sell it. They want to sell it quickly. Might be a really fair price. A lot of times it's, hey, if we ask $2 million, maybe we'll get something close to that. It's probably not worth $1.5 million, So you just, you just have to take a look at it and look at it with a grain of salt.
And something that also we need to be aware of, that if there's 3 appraisers were hired, 3 different appraisers, you're going to get 3 different values. So that this is where it comes with that appraisal is an art and a science at the same time. It's not an exact number. The value is going to be between that 7 and that 8 cap. You may get one that says a 7.5, one that says an 8, one that says a 7. But it's actually a range of value that you're getting. I don't think it needs to be that broad, but you understand what I'm saying, Rusty? And would you agree with that?
Yeah, I would absolutely. And once again, it depends on what it is. To go back to the Dollar General example, the correct cap rate should be very narrow at any given time, because there's enough data out there and enough of these things selling, and the income is so predictable. It is what it is. Like whatever they're paying you in rent, that's what it is, because they're doing all the operating expenses themselves. They're paying all the CAM, they're paying the real estate taxes, they're paying all that stuff themselves. All you have to do is walk to the mailbox and get a check. So you know what the income is, and it's going to be flat for 15 years. So there's enough sales out there to tell you, hey, this cap rate should be 7 or whatever it is. So in a case like that, it's still an opinion. There's still a range, but it should be a very narrow range among appraisers. As you get to properties that are a little more weird and there's more assumptions that go into it, that's where you're right. It's a science, because we're trying to gather as much data as possible and then formulate our opinion based on here's the methodology, here's this, and here's what we're doing. But it's an art in terms of, if I say the rent's $15 up here, that might be at the top of the market. Okay, well, if I'm looking at my vacancy rate, would my vacancy rate be consistent with the market? Well, if I'm forecasting a rent that's a little bit higher, I might want to think about a little bit more vacancy. Whereas if I put a little lower rent on it, I could probably put a lower vacancy, because there's a greater probability that I can lease it up for that. And depending on, how conservative or heroic your assumptions are, that impacts your cap rate, your rate of return. If you're making assumptions that are a little riskier, you probably need a little riskier cap rate, which is a little higher. So it really just varies and it depends, but you're right. I mean, it's a science, because there's a methodology. We've got a big textbook. Here's what we do. Here's the accepted methodology. All that is science, but at the same time, it is certainly an art form, and there is certainly a range of value for every property. And you're right, 3 appraisers can have 3 different opinions, and it doesn't mean that one of them's wrong. And that's just one of the things that we run into is, people open up an appraisal report and they see that number and they're like, that's what it's worth, he's wrong, whatever. Well, that's the thing that gets me is, I keep my office TV on CNBC or whatever, and I can sit there and watch the stock market bounce up and down all around, whatever. Does that mean that it was wrong 5 minutes ago? I mean, things change, and it's an opinion.
Right.
And, it's just funny how as appraisers, people treat your value as a fact. And it's like, no, it's not a fact. It's an opinion. And things are constantly changing that might, change that opinion. So, it's just a little unique and a little interesting, and I always find it funny when you have a multi-billion-dollar corporation whose stock price drops 20% in a day. Whereas if I'm off 1% on a value, people want to hang me out to dry.
You're the worst appraiser. It doesn't matter your education or anything at that point, because you get their number.
Yeah. So, it's just, interesting, but you're right. It's a science and an art. At the end of the day, it is an opinion, and different appraisers have different opinions. It doesn't mean that one's right, one's wrong. There is always a range of value, and I'm a firm believer you can have multiple different values in that range of value, and everybody be reasonably correct. The hard part is, when does it get out of the range of value or out of the gray area or whatever? There's not anything that says, there's no red light that goes off that tells you when you're outside of a reasonable range, because it's all an opinion. So
yeah, you're just going against the grain of your other appraisers at that point. I was going to say, and I know we talked quite a bit about the appraisals, but one thing I'd like to ask you before we move on to something a little different.
About the market?
Yeah, about the market itself that we're in right now is, I know that when you get an appraisal, you typically get an appraisal to what the property is worth today in its current condition. But there's also in appraisals for a future value of the property. They call it, I believe, an after repair appraisal or an as renovated appraisal. Can you talk a little bit about that? I'm trying to find out, is there a time limit on the renovations? Can you do it for 5 years out in the future? Or is it typically like a 2-year in the future value that you're projecting? What are your opinion on that?
Yeah, there's no hard and fast rule that says, here's what you can do, here's what you can't do. Every, I guess, financial institution in this case would probably be different and have their own rules. I mean, you could be appraising a property that could take a couple of months to do a renovation. You could be appraising a proposed property that might take two or 3 years to construct. In that case, you're looking a couple of years out in the future. There's no hard and fast rule. And I had this discussion with a property owner. We were out their property a couple of months ago, and he was just saying, I don't really understand how, I know we're wanting to build this building. I don't really understand how you can appraise this building because it's not here yet. And I said, well, and I never quite thought of it that way. And I said, well, fair question. Basically, I'm looking at your plans and specs and what you're going to build and your construction budget, and you're essentially appraising that property as if it was built now. And if it's like it's going to be an office warehouse or an apartment building, it's going to be like this one. I can go look at that one and, hey, I got a good feel of what this is going to be when it's done. And you're not appraising it on a hypothetical basis as if it's done on that date. That's something that we can do also. But really, you're saying, look, in 2 years, this property is going to be here. Here's what we think the rent's going to be, the expenses. Here's what we think the property's worth, and so we'll give an as-is value. Here's what it's worth now. Might just be a land site. Here's what it's going to be worth when it's completed. It might be a property that needs to undergo lease up. Hey, I've got a Walmart that's going in here, but I'm going to build about 30,000 feet of shop space too, because I know tenants are going to come. A lot of them might be there when it's done, but it might not be fully leased by the time the Walmart's completed. So you might give a value at completion, but then also a value at stabilization after it's fully leased. So those are all things that we can do and do regularly. There's no specific time frame or anything. That's generally how it works. And that's why we do it and kind of how we do it. And it really just depends on each specific deal, because a bank can't tell you, well, you can't give me a value that's more than a year in the future if you're appraising a property that's going to take 2 years to build. That's not really something we run into to answer your question. It kind of is what it is. Yeah. How long is it going to take you to build? What's the completion date? And then it might be our job to say, okay, here's how long I think it's going to take to stabilize. So maybe that valuation date is something that the appraiser comes up with based on looking at the market.
Got it.
So hopefully that satisfactorily answers what you're asking.
Yes. And it sounds like it's a very flexible process that you're looking to meet the requirements of the lender or even the requests of the investor. You can pretty much create I'm thinking about like an ice cream shop. You can do the ice cream however you want. Just tell me how you want it and I can create it. And depending on the amount of work that it entails, there's a fee for that, but also to make sure that it's accurate, there's an explanation. So.
No, that's right. And we don't have a magic crystal ball or anything like that. But at the same time, I mean, you're trying to, the purpose of doing, the bank's making a loan. We're going to make a loan. It's going to be a construction loan. Okay, well, we expect this property to be done 2 years from now. Okay, 2 years from now, what's it going to be worth? Because at that point, we're going to want to put permanent financing or whatever. So what you're just trying to mimic, you're trying to mimic reality is all it is. So that's generally what we try to do.
Now, just hearing that, it makes me a little interested and curious, I guess, because I know you said that sometimes they ask you, like, how are you valuing this property if it's not even here? Or even for current properties. Have you ever had where someone questions the value you put on a property? And if they do, how do you go forward with someone that may say, I understand you're giving me this value, but I think it may be higher than what it is?
Well, that's interesting because nobody's ever questioned.
That doesn't happen to you, Rusty. Never.
No, it doesn't happen to me. I've heard it happens to other people, but it never happens to me. No, it does happen, and it happens a lot, as you can imagine. You have to remember, as an appraiser, I'm an unbiased third party, and we even sign a certification that says, look, I don't have an interest in this property. I don't have it in for one of the owners, or, one of the owners isn't my best friend. I mean, I'm just an unbiased third party trying to give you an honest opinion. So, that's number one. And then, the other parties that involved, they do have a vested interest in the property. And I understand that. There are times when the bank might think we're a little high, and of course the borrower thinks we're a little low. What I usually do is, with the understanding that, look, there's always a range of value, and you kind of know where you are in the range. At least I think you should. And in some cases, there's reason for, look, I think we could be at the upper end of the range here. This property is proposed, for example, and maybe the income approach doesn't quite support it, the sales approach doesn't quite support it, but you know what the costs are, and you know what it's costing them to build it. And it's higher than your value estimate. So you can kind of move towards the upper end of the range because it costs what it costs. That doesn't mean that that's the value. So, you're always in that range of value. I'll have a good sense of where I am in the process. So if somebody calls and says, hey, can you tweak this up a little bit? I think you're wrong. There might be some room to tweak it up a little bit and say, okay, we could tweak that up a hair. But there might be cases where you say, look, we're already kind of at the upper end of the range here, and here's why. So maybe I don't feel comfortable doing that. But always, to your point, what can someone do if the value comes in lower than they want or whatnot? The first thing I always do, and it's not a defense mechanism, it sounds like it, but it's like, look, I'm doing my best to go out into the market and scour the market and get data, rent data, sales data, whatever. If you have any comparable information, similar properties that have sold, that have leased, that support what you're telling me here, please send it to me. I will happily, we're in the data business. I will happily take free data all day long that I didn't uncover. So I always say, look, please send it. I'll take a look at it. If it's something that we just, happen to miss, and I, verify it and say, hey, that's right. Hey, that can help your case tremendously. But, a lot of times what you get is, your number's wrong and this, that, and the other, and say, okay, send data. What other sales do you have, or what data do you have to help me? Mm-hmm. It's like, well, I don't even know. I didn't even look in the report to see what comps you used. I just, I looked at the first page and I know the number's wrong. I'm like, well, that's not very helpful for me. So, at that point, we just have a difference of opinion. Mm-hmm. And I'm happy to change my opinion for good reason. So the best thing you can do is come with good data. Here's some stuff I would like for you to consider. I think a good appraiser will always consider additional information. They should. So that's probably the best way when you kind of have a disagreement is, first of all, let's talk through it. What's your opinion and why? Why do you think I'm wrong, or why do I think I'm right? Is there any wiggle room here in terms of the range of value and what's reasonable? If there's not, are there any facts that might change my opinion or change that range? Because if I find out the building across the street that's very similar to mine just sold for 10% higher than what I appraised it on because it literally just closed yesterday, and I missed it, then obviously that's pretty material, something I'd want to know. So the best thing you can do is come with data in hand to provide for consideration.
Got it. So I think, and that means a lot, Rusty, that you are willing to say, I'm willing to change my opinion if you can provide data that substantiates
your opinion.
Yeah, that substantiates the other party's opinion, because a lot of people aren't willing to do that. So that makes a lot of sense. And something that we try to do when we do an appraisal, when we're having an appraisal done, we try to do the market analysis beforehand as much as we can to provide the appraiser and say, look, this is where we're getting our numbers from. These are some of the comps. These are some of the rents. So that way they have some information, and then that helps substantiate our case. With what
they won't always go with it, but
yeah, they may or may not go with it. I've had situations in the past they haven't,
which is fine.
But at least we're able to provide it and help our case.
Right.
No, and I think that's always good to do. And a lot of people, think, well, I don't want to do the appraiser's job for them. If I give them all this stuff, they don't have to do anything. It's like, well, that's not really true. But what you have to keep in mind is, I think it's better to provide it up front. I mean, I'll admit I'm guilty. When I've got an appraiser who's appraising my house or whatever, knowing that I'm an appraiser, I won't, stick my MAI business card in his hand when he comes in. But I'll say, look, I'm an appraiser too, and here's the 5 comps I think are the best comps. Here you go. I'm not trying to do your job for you. You do your job. But here's what I think, and here's why. Now, should I do that? I don't know. But, at that point, I've got my homeowner trying to get his house refinanced hat on. I don't have my appraiser hat on. But I always think it's a good idea to give the information you have. I think some people kind of have a false misconception of, well, let me let the appraiser come up with his idea, because he might even have a higher number in mind than I do. Usually the way that works is he comes in, of course it's your property. You probably think it's worth more than it is worth. So the appraiser doesn't come in higher. He comes in lower. And then you want to come out and say, well, what about this and what about this and what about this? Well, first of all, you just made your appraiser mad, because it's like, look, if you had all this info that you want me to consider, why didn't you give it to me in the first place?
Yeah. Is that what you're saying?
Why didn't you
don't fight your appraiser?
Yeah, why didn't you give it to me in the first place? And then secondly, once he or she's already done the appraisal report, in their mind, they feel pretty good about that number, or they wouldn't have put that number on it in the first place. So, like I say, if you come with something that's good and material and, hey, it changes things, then I think you should still take it into consideration. But, I'm a big believer in efficiency. If we have an issue with a client, or we're doing an appraisal and here's what we have, and, I have questions about the property, or, you've asked for this valuation area. Well, this isn't really what we need. We could do it this way, or we could do it this way. I mean, I'll pick up the phone and call them and say, look, I would much rather let's spend 5 or 10 minutes talking about this. Let's get this squared away up front so that we're all on the same page with what we're going to do. Because I don't want to write up a report, because, our reports are on commercial properties that are 100 pages long or whatever. I don't want to go down this road of, here's how I analyze this, send it to the reviewer, and them say, oh, well, we really kind of wanted you to do this, so can you just change that? Chances are it's not going to take 5 minutes. It might take an entire day to redo all this stuff that I did in this portion of the report. So it's absolutely worth the 5 or 10 minutes at the beginning of the process to have that conversation and make sure we're on the same page. And I think the same is true, from a borrower or a property owner. I think it's important to just go ahead and say, hey, let's just get all the cards out on the table. Here's what I have. Consider it. Don't consider it. Because, like I say, once an appraiser kind of turns that report in, he's a pretty firm believer in his number. And it's harder to get him to change his mind once he's already made up his mind, as opposed to, hey, let this be part of your decision-making process. Mm-hmm. That's my thought.
Got it. So to rehash what you just said, and there's a bit of professional etiquette, and also to keep things efficient to make sure the appraiser is using their time effectively, because they're putting in a lot of time to put these reports together. So work beforehand, before they start the report, provide the information to the appraiser to substantiate your value. You're the one that's interested in your value as the buyer or the seller. So give them as much information as possible. And then if there's something that's in there that's incorrect, bring it up to their attention. And have a conversation if it's material. But in the end, don't try to not provide any information when the information was available. And then at the end of the valuation, try to fight the appraiser on their value, because it's just, in the end, it's not going to get you anywhere. Oh, you could bring it up, but it just needs to be something material. Would you agree with that, Rusty?
Yeah, I think that's fair to say. And the only additional thing I would say is, when you're dealing with banks, the amount of interaction that the appraiser and the borrower has is usually very limited.
Okay.
And they want to keep that limited for the most part. Like on the commercial side, very seldom do we get to talk to the loan officer, who basically, the way it works, you have a borrower, he's talking to his buddy who's a loan officer, whose job it is to drum up business for the bank. They go out to lunch, they say, yeah, I'm going to let you guys refinance my property. Okay. They kind of sign it up, and then it goes to the appraisal department, who actually orders the appraisal.
Mm-hmm.
That's who hires us, and they want us talking to them. A lot of times I'll be able to go to the buyer and say, hey, I need property information. I need to inspect your property. Here's what I need from you. And that would be the time to say, okay, I'm going to send you this, and I'd send you some additional information that you consider, whatever. Okay. That's kind of where it needs to end, because the banks are extremely strict in terms of, I'm not allowed to have conversations with the borrower about values or communicate anything whatsoever other than factual information about the property. And they make that very clear. And usually, in terms of the loan officer at the bank, obviously their job is to get the loan closed, and they want it to be able to lend their buddy as much money as possible. So they really limit the interaction that I have with the loan officers. And I've got friends who are loan officers, and I'll see them out at the golf course or the swimming pool or something like that, and say, hey, you just did a loan for me or an appraisal for me. And I'm like, really? It's like, yeah, this building. I was like, well, we did that 2 months ago. And he said, yeah, it just closed yesterday or a week ago. And I didn't even, they're a buddy of mine. I didn't even know they were doing it. And they didn't even know I was doing the appraisal on it until they got it. They really limit the interaction that we have. So I just think that's important to kind of reiterate to everybody, that your appraiser is not necessarily always very accessible. Mm-hmm. The best time for you to get data to them is when you're doing the property exchange of information or setting up the inspection, because once the appraisal is done, you don't have access necessarily to the appraiser. You're going to have to go through your loan officer, who's going to have to go through the appraisal guy at the bank. And the loan officers are not even going to talk to the appraiser. They won't even know who each other is. You kind of have to seize this is your opportunity to kind of, give any information you've got, whatever, because, we hold pretty strictly to that standard. We're not talking about values with anybody except, in the case of a bank, the person in the appraisal department that handles it. You've kind of got a limited opportunity to plead your case, so to speak. But I did want to get that out there, that it makes it sound like in the first part of the conversation that, we were having these conversations with the borrower all the time. We're really not. I'm saying this is when it comes up and every now and then, but it still goes through kind of an intermediary.
Makes sense. To have that separation.
Anyway, that's how that works.
Yeah.
Yeah.
To have
and
that
the bank, ever since, late 80s, early 90s, when this separation was invented, they hold pretty strictly to it.
Got it. Okay. So closing, before we get ready to end the call, we have just one more question. And this one is, what are some of the biggest mistakes you see investors make regarding valuation of properties?
Very good question. And like I say, I do a little bit of investing, but not a lot, not nearly as much as I would like to. And so I kind of hesitate to answer the question just because I think about book critics. There's a reason somebody's a book critic. It's because they can't write. They can't be an author. So I don't want to be the appraiser telling investors all the mistakes that investors make, because they're like, you're an appraiser. Why aren't you putting your money where your mouth is? So I don't want to come across that way at all, because I think it's a very valid point. These guys, as appraisers, we're just reporters. All we're doing is reporting on the market, and we try to be as current as possible. But there are guys out there who are actually making the market.
You answered that very well. I don't know if you're considering running for office, Rusty. Smart man.
No, when I was in Washington, D.C., it was as an appraiser, period. Wasn't running for office. No, but to really answer your question, in terms of the mistakes people make, if I could answer it simply, it's it's just getting a little heroic in your assumptions and getting emotionally invested in a particular property, and you really want to do this deal. And, I think we can get this for rent, and you just get so excited about it, and you kind of just start drinking your own Kool-Aid, and you can't step back and take an objective look at the property because you're emotionally invested in it at that point. And I've had several people tell me, sometimes the best deals are the ones that I didn't do, not the ones I did do.
Mm-hmm.
You have to be able to step back.
Yeah.
You have to be able to take an objective look. Sometimes, and I know you guys have had experience with this, you want somebody else to take an objective look at a property for you. Hey, what are we missing here?
Right.
Or is there something we're missing here? And it might cost a little money, but it can save you a ton of money down the road. So
great investment.
The biggest problem is just, getting some people that you trust to, hey, can you take a look at this? Are we okay here? Because a lot of times you end up with blinders on, you don't even realize it. And you just get so emotionally caught up, or you want to do this deal or whatever. And it might be the right investment in the right location, just at the wrong price.
Mm-hmm.
And there's an old saying, you make money on the buy, not on the sell. So I wanted to make sure I answered that question, because you did ask a very good question.
No worries. No, I appreciate it. I think that was a great answer. So, and that was going into a new market. What we did, and we hired Rusty because we weren't familiar with the market. We wanted to have a better idea of the value. And by having those second eyes, we actually didn't do the deal. And it was a great decision not to do the deal. We paid for an appraisal, and it was well spent. It was one of the best forms of money we've spent in a long time, because not doing that deal. So with that, I'm going to say thank you, Rusty, for taking the time to spend with us on the call. It's so much information. I think people are going to benefit greatly from it.
I agree.
Now, how do people get in touch with you and your company, and what market areas do you do appraisals in, or can you advise people in?
Yeah, sure. Well, first off, Denny, Desiree, thank you very much. It's been real fun, and it's been a pleasure. But yeah, our company's Integra Realty Resources. We're a national commercial real estate appraisal firm. I'm in Birmingham, Alabama. We cover, my office basically covers everything in the state of Alabama, from Huntsville and, the Shoals all the way down through Mobile. And I've got an appraiser who's down in Mobile. So that's where we are. But nationally, we've got 55, 60 offices all over the country. Our company motto is local expertise nationally, because we really have tons of great offices and have specialists dispersed throughout the country. So, if you want to look us up on the internet at IRR.com, Integra Realty Resources, we've got lots of great appraisers all over the country, and it's a really great group of men and women. So.
Excellent. Well, again, Rusty, thanks for taking the time. And let's, whenever we're in your neighborhood, let's see if we can get together for lunch.
Absolutely. My pleasure. So take care, and we will certainly talk to you soon.
Sounds good. Take care.
All right. Thank you.
Bye-bye.
Bye.
Thanks for tuning in. I hope you enjoyed the call with Rusty and feel a bit more comfortable with commercial real estate valuation. To learn more about real estate investing or how to be a capital partner, visit our website at www.everythingaboutwealth.com. If you like the show, make sure to subscribe and like us on iTunes or your favorite app so other people can find the show. With that, see you on the next show. Take care.